Paying tax earlier on purpose sounds backwards. Why give up a tax break today when retirement is decades away? Because a Roth IRA makes a very specific trade. No deduction for the money you contribute now in exchange for the possibility of tax-free qualified withdrawals later. Think of it as choosing when to tax a crop. With a Roth, you pay tax before the seed goes in. If the rules are satisfied, the qualified harvest can come out free of federal income tax. But CAN is doing important work. A Roth is not automatically the best account for everyone, and opening the account does not by itself purchase an investment. Over the next few minutes, we'll cover what the account is, the 2026 rules, what you can generally take out first, how to open and fund one, and the mistake that can leave a fully funded Roth sitting almost completely still. A Roth IRA is an individual retirement account with a tax label attached. The label controls how contributions and withdrawals are treated. It does not choose what you own inside. The investments available inside a Roth depend on the trustee or custodian. IRA trustees may impose restrictions beyond the investments barred by law. A brokerage account, for example, can offer stocks, bonds, mutual funds, and exchange-traded funds, while money not invested may remain in cash or enter a cash sweep. The account is the wrapper. The investment or cash position is what goes inside it. That distinction solves a lot of confusion. Opening a Roth does not create a return. Depositing money does not guarantee growth. An investment can gain or lose value and charge fees. Uninvested money can remain in cash. The Roth label changes the tax rules. It does not remove investment risk or fees. And because Roth contributions are not deductible, putting $1,000 into a Roth does not generally reduce this year's taxable income. That is the price of the trade. So when can paying tax now make sense? Start with 2 clocks. A deductible traditional contribution may give you a tax benefit today, while traditional IRA amounts generally are not taxed until distribution. A Roth contribution gives up that deduction today, while qualified withdrawals can be tax-free later. Which account leaves more after tax depends on assumptions, including deduction eligibility and the tax rates that apply when the contribution and withdrawal occur. Under an otherwise comparable illustration, a lower marginal tax rate today than at withdrawal can favor paying tax earlier. A higher rate today than at withdrawal can make a current deduction more valuable. That is conditional arithmetic based on the different tax timing, not an IRS prediction of future tax rates or a personal recommendation. Before choosing where the next retirement dollar goes, check your workplace plan. The Department of Labor says that when an employer offers a match, workers should contribute enough to receive it. Match terms are plan-specific. This video is a framework, not a personal tax recommendation. Now the current year guardrails. For 2026, the combined limit across your traditional and Roth IRA contributions is $7,500. If you are age 50 or older, the catch-up amount is $1,100, for a possible total of $8,600. Your limit can still be lower if your eligible taxable compensation is lower. Direct Roth eligibility also phases out with modified adjusted gross income. For single filers and heads of household, the 2026 phase-out runs from $153,000 to $168,000. For married couples filing jointly, it runs from $242,000 to $252,000. A special $0 to $10,000 range applies to certain married people filing separately who lived with a spouse during the year. Those are phase-out ranges, not cliffs at the lower number. Inside a range, the allowed amount is reduced. At or above the top, a direct contribution is not allowed. These figures change, so verify the year before funding. And remember, the IRA limit is shared. You do not get a full traditional limit plus a separate full Roth limit. Roth withdrawal rules are not one simple 5-year rule. For a distribution that is not qualified, the IRS ordering rules generally treat regular contributions as coming out first. Then come conversion and rollover contributions, generally oldest first, with taxable portions before non-taxable portions. Earnings come last. That ordering is why regular Roth contributions are often described as coming out first. But do not turn that summary into all Roth money is always free to withdraw. Conversions have separate 5-year recapture considerations, and earnings are treated differently from contributions. For the entire distribution to be qualified, the Roth must satisfy the 5 tax year requirement, and the payment must also meet a qualifying condition. After age 59 and a half, disability, death, or an eligible first home distribution within the lifetime limit. The safest beginner mental model is 3 labeled layers, not one pile: contributions, conversions, and earnings. Before withdrawing, confirm which layer you are touching. Here is the hypothetical behind the big visual. Suppose someone contributes $200 at the end of every month for 40 years. Total contributions equal $96,000. Now assume a steady 7% nominal annual return, compounded monthly. Under that smooth mathematical assumption, the ending value is about $525,000. Roughly $96,000 came from contributions. About $429,000 is hypothetical growth. This is not a forecast. The calculation assumes the same return every month and omits inflation and fees. Actual investments can gain or lose value, and fees reduce returns. But the example shows why tax treatment on the far end can matter. If that eventual Roth distribution is qualified, the federal income tax treatment can apply to the full qualified withdrawal, including the growth. The magic is not Roth. The engine is time, contributions, and investment return. The Roth is the rulebook around the engine. Now the expensive mistake. Someone opens a Roth, transfers money, sees a cash balance, and assumes the job is done. When money is deposited into an investment account but not used to buy an investment, the firm may place it in a default cash sweep or leave it as a cash balance. That cash does not own the stock or bond fund the saver thought they bought. Depending on the cash arrangement, it may earn a variable rate, a lower rate than another option, or no interest. So after every first deposit, ask one brutally simple question: what did the money actually buy? Review the transaction confirmation and account statement to verify that the order was authorized and the intended holding appears. If your choice is cash on purpose, fine. The mistake is not cash. The mistake is believing you bought another investment when the money remained uninvested. Here is the clean setup sequence. Step 1, choose a custodian. Compare the investments it offers and the fees that can apply. Ask how it handles uninvested cash. Step 2, open the account and make sure it is explicitly designated as a Roth IRA. Designate a beneficiary using the custodian's procedure. Protect the login and do not share account credentials in response to an unsolicited message. Step 3, fund it within your personal limit. Check taxable compensation, filing status, modified adjusted gross income, other IRA contributions, and the tax year assigned to the deposit. Contributions for a year can generally be made through that year's tax return due date, excluding extensions, but the screen should clearly show which year you selected. Step 4. Choose the investment, place the order, and verify the holding. If recurring saving fits your budget, a bank or credit union may let you schedule transfers to an investment account. After a transfer, still verify whether the money bought the intended investment or remained cash. Open, fund, invest, verify, 4 verbs. Skipping the third one is how a retirement account becomes an expensive parking spot. So why can paying tax now win? Because giving up a deduction today can buy access to qualified tax-free withdrawals later, and in the episode's hypothetical, decades of assumed growth make the far end much larger than the seed. But can a Roth win? Is not the most useful question. Ask 3 better ones. What tax benefit am I giving up today? What rules and flexibility will matter before retirement? And once the money arrives, what investment will it actually own? Check the current limits. Separate contributions, conversions, and earnings. Treat the return as uncertain. Then make the tax choice with the full picture and a qualified tax professional when your situation needs one. This is general financial education, not personal financial, tax, or legal advice. If this finally made the Roth IRA click, subscribe to Plainly Money. No hype, just money plainly.